Good morning, ladies and gentlemen, and a warm welcome to today's webinar. My name is Abdullah Mohammed. I'm a sales executive at Vanguard, and it is my pleasure to be your moderator today. Joining me are two esteemed panelists. We've got Manfred Stüttgen, Professor Manfred Stüttgen from the Lucerne University of Applied Sciences. Good morning, Manfred.
Good morning, Abdullah.
And also Oliver Maas, Global Head of Activities from the Swiss Association of Wealth Managers. Good morning, Oli.
Morning, Abdullah.
Nice to have you here. Today's webinar is about the Investment Pulse study that we've conducted now for the third consecutive year. And in this study, we're analyzing the investment behavior of Swiss independent wealth managers, their asset allocation, product preferences, appetite for ESG, and in this year's edition particularly, we're looking at the operational side, so how they manage processes. Before we start with the webinar, I would like to remind you that you have a Q&A box in your interface, and you can ask us questions which we'll receive live here in the studio of Zurich. And secondly, if you want to download the study with the executive summary, you can do so by either downloading it from the Resource Center or clicking on the link of the email that you will be receiving after the webinar. So let's dive into the content. Manfred, you've been conducting the study, you have all the data and the insights. Could you give us an overview of the study setup and how many Swiss wealth managers actually participated in this year's edition?
Sure thing. Well, thank you, Abdullah. I'd like to introduce you to the setup and the methodology of our study. And this year, 161 independent wealth managers have participated in our study, which is quite a good sample size and pretty representative if you think about the number of independent wealth managers in Switzerland. It depends on how you count it. I think approximately 1,200 have already received the FINMA license, and another 400 plus are in the process of applying for the license. So 161 is pretty representative of the industry of the Swiss independent wealth managers. And if you look into the qualitative side of things, you can see that it's pretty much balanced. We have, according to the sizes, if you measure size by the assets under management, you can see that we have all different segments, smaller ones, where we do the cutoff point, let's say, by lower than 200 million assets under management in Swiss francs. The bigger ones, 200 plus, some people say maybe 400 plus. If you would cut it somewhere between 200 and 400, it's around 50-50, smaller ones and bigger ones. If you compare the sample size to the 2023 study, it has increased significantly. Last year we had 109 participants, this year 161, and we have an increase particularly in the larger independent wealth managers who have participated in this study. And I will here and there go into more detail whether or not they differentiate themselves. That is kind of one thing. The other thing is, if you look at the regional setup of the end client's domicile, then you have a cluster, obviously, of end clients who sit in Switzerland, and it's approximately, I think, 47 or something percent. Mm-hmm. Then you have like 39% clients with an end domicile in the European countries, and then like something like 1, 2, 3, 4% in other areas and regions of the world. That is one thing to keep in mind when we go through this, because it might have also something to do with asset allocation. The third thing that I'd like to mention here is also very important. You can see that in the presentation that we've shared, somewhere in the footnote, but we have, from these 169 wealth managers that have participated, 45% of them do cater to institutional clients. So they have at least one institutional clients who they deal with. But 98% of the participants say they also do have private clients. So that's a good mix also in terms of the client needs who they look after.
Thank you, Manfred. Seems that we have a great diversified setup. Oliver, you from the association have supported us with your valued members by distributing this survey. Now, if you hear the numbers from Manfred and the sizes of the sample, do you see any biases, or is this actually representative from what you see with your members?
I will never say it's not representative, but what we see is that when I recall what you said, that the segment of over 800 million is roughly 28% in the sample. That's I would say that's a little bit over representation of the larger ones. We calculated about 4 to 5% are in that bracket, and that almost 60% of the asset managers might be in the bracket 0 to 200 million. So the larger one seems to be slightly overrepresented in that sample. But other than that, I think we can say still a representative sample.
Great to hear. Manfred, last year we had a challenging environment, a challenging investment environment for Swiss wealth managers to navigate through, right? We had uncertainty about the soft landing, the Magnificent Seven stocks delivered an outstanding performance. And therefore, I'd like to know, how does the asset allocation of the Swiss wealth managers look if we compare this year's edition to the previous one?
Yeah, before I jump into the asset allocation immediately, let me just give you a brief overview of like the 1, 2, 3 questions we've asked. We have asked for the asset allocation part. We've asked them whether or not they invest directly or through funds and ETFs. And we asked them, those of them who invest into funds, whether or not they prefer active or passive ones. So these are that's the block of things I'd like to talk about. And I'll start with the asset allocation that you're asking for. And what we've observed is, not surprisingly so, that the Swiss equities have been overweighted by the majority of the participants in this study, which means I need to explain how to read this. I mean, this is not an individual asset allocation, but it's the average of the 161. So the average or the majority tends to lean towards overweighing Swiss equities. And it is more or less in line with the same results we saw in 2023. What is more interesting maybe is that we've seen a change in the allocation of the US stocks. So US stocks, like Swiss stocks, are now being overweighted by the majority of the individual wealth managers. And there has been a major shift there. That is what strikes us on the equity side. I mean, for the rest of the equities, like let's say the European ones, there is a small underweight, but also for Asian Pacific markets, including Japan and also emerging markets, they are slightly underweighted. That is the picture on the equity side. Let's look into fixed income. Here, it's a different picture. I mean, basically, except for European and US corporate bonds, all bonds are still being underweighted by the majority of the individual wealth managers, excuse me. What we also see, if you look at the overall picture, there is a shift. I mean, there is an increase of weighting. So the average of the wealth managers has increased their weighings compared to 2023. That's sort of the picture that we've observed here.
So you see that one red dot is moving to the right, and that's the US equity proportion, but overall it's tending to go more towards an overweight. Now, Manfred, if we look at the implementation, right? How do Swiss independent wealth managers implement their strategic asset allocation? Do they tend to use direct investments, or do they tend to use third-party products such as mutual funds or ETFs?
Yeah, I mean, here we see a pretty interesting and mixed picture. On Swiss equities, which I assume the wealth managers in Switzerland know very well, there they love to directly invest. Yeah, that's, I mean, plausible, I would say. There is a continuity compared to last year as well, that the further you go on the equity side, the more the wealth managers tend to prefer products like funds, ETFs, and so on. So the more indirect they go, and this is particularly true for Asia-Pacific markets as well as for the emerging markets. So there they very strongly have a preference for products, so to say. A different picture on the fixed income side. If you look at how they allocate in the different markets, they prefer direct investments in basically all of the bonds except for emerging markets and high yield bonds. So on the government bond side, Swiss, Europe, US. On the corporate bond side, Swiss, Europe, and US. They are all more often than not directly invested. And there has also been, if you compare that, there's a pattern, there has been a shift towards more direct investments overall. And it is important to keep this picture in mind when we continue, because some of the questions we asked in our survey build on this one, so there is a path dependency here. Yeah? The next questions we ask build on those ones who use funds and ETFs. Yeah? But keep in mind, particularly on the bond side, the majority is directly investing.
Thank you, Manfred. So slightly more biased towards direct investments. That's the summary of this slide. Now you've mentioned already the following question, which is the usage of the products. So the ones that do use third-party products. It would be interesting to know whether those products are actively managed or passively managed. Do you have any insights on those?
Yeah, absolutely. I mean, it is a very balanced picture, I would say. I mean, it is like, I mean, you need to look very closely into this, but active and passive are more or less equally preferred by the wealth managers. On the equity side, the Swiss equities are slightly more actively invested, as well as the European ones. If you look at the emerging markets and Asia Pacific, they are slightly being more passively invested, and the US has seen a slight shift, but it's very close to being balanced. On the bond side, the picture is slightly different. The pattern here is that government bonds, no matter which segment, they, well, except maybe Europe, but government bonds in general, they tend to be more passively invested, while the corporate bonds are being much more actively invested. Yeah, and with emerging market bonds, it's sort of balanced, and also with high yield bonds. But in general, there's a trend to the middle. Yeah, in the past, last year, 2023, there was a bigger spread, so to say. This year, we've seen everything being more, I wouldn't say undecided between active or passive, but there seems to be a consensus that 50-50, so to say, would be fantastic.
Probably connecting the best of both worlds,
exactly.
So to say. Perfect. And within the passive range, so the Swiss independent wealth managers that do use passive investments, right? We do have index funds, we have ETFs, we have both as an option. Could you allude on the usage of those wrappers?
Yes, absolutely. I mean, here we have a very simple picture. Honestly, the wealth managers who do passively invest, those ones love to invest solely in ETF funds by the majority. So the majority of wealth managers uses ETFs only in the, if you look at equities, like by 60%. And last year it was like 40% who use ETF only. We also have those individual wealth managers who use index funds only, but they are definitely fewer. Yeah, it's like around like 9 to I think it's 9 to 10% or something. Last year it was 9%. This year was 10%, and then you have this year approximately a third of the wealth managers who use both index funds and ETFs on the equity side. But you see on the equity side that there was a jump of those wealth managers who use ETFs only from 40 to 60%.
So ETFs being more preferred on the equity side. What about fixed income?
Much more. On the fixed income side, it is a bit of a similar picture, but there are not that much there's not that much of a shift. So if you, for example, look at those who use ETF only to invest their bonds, it is a fair 49% share, almost half of them do this, and it's basically stable. Last year we had the same result. What has shifted though on the bond side is that more and more wealth managers use index funds only. Not both of them, but index funds only. It is still the minority. I mean, it has increased from 14 to 17%. But, I mean, if you looked another year back, 2022, it was 12%. So even if it's still the minority who uses index funds only to expose themselves to bonds, there is a path and it's an increasing one. So there is a pattern.
Pretty interesting. But overall, would you say that ETFs dominate?
Absolutely. I mean, it's a very clear picture. On the equity side, on the bond side, ETFs are the preferred investment vehicle to manage passive portfolios.
Excellent. So this was the asset allocation part, right, and the product preferences. Before we jump into the portfolio management process this year, I would like to remind you once again that you can ask questions and we'll get them live here into the studio, which we'll then answer after the slides have been presented. So moving on to the portfolio management process, Manfred, could you allude on the data, what has been asked and what the preferences is? I mean, there are many ways to manage your operational side. You can use internal tools, external services. What picture can we see here for Swiss independent wealth managers?
Yeah, that's a good question. And let me give you the big picture first. We've asked 3 questions on how they manage their core processes related to portfolio management. It's like kind of, we needed to ask them first for the 5 different processes that we described. And then we also asked them for an outlook, whether or not they wanted to change something. And also, if they wanted to change something, what the motives were. Let us go to the first question. And this is the first year where we asked this question. So we didn't ask that question in the previous years. We can't make any comparisons there. But it is a bit of a complicated question, to be very honest. It has 5 dimensions, which are the 5 processes. It starts with the portfolio construction, then it goes into the second process, risk assessment and portfolio monitoring. You have the product selection process and the product suitability process, and then you also have the rebalancing process. And I mean, in a way, it's 3 portfolio management processes plus 2 processes related to product selection and implementation. And to make things more complicated, we have a scale. We've chosen a scale with 5 degrees. And you already mentioned sort of the poles of the degrees. You can implement your portfolio construction process completely internally, based on internal tools, based on not using external suppliers, or you could possibly use external tools or outsource these things. And if you look just into this process, you see that it is, I think it is 69% of the wealth managers who completely do their portfolio construction, their asset allocation process internally, based on internal methods, based on internal tools. And it is a very negligible, something like 5% or so, who does it based on external tools and external services. Yeah, and that picture is sort of similar in a way also for the rebalancing process. Slight differences in the numbers, but the majority by far, or 3/4 of the wealth managers, they really like to do these things internally mainly and less externally. And the intermediate scales is like 75 to 25, 50-50, 25 to 75. Some of them do sort of mixed things there, so they mainly do it internally, use some external sources, and so on. You can look into the details here, but the overall picture is clear. A very heavy reliance on the internal processes. Slightly less so on the risk assessment side and portfolio monitoring, but still sort of the same shapes. Where we see some differences is with product suitability, but also with product selection. Let me pick product suitability as one of the processes that has to do with managing the risks of the clients, the tax domicile, things like this, compliance issues. There we see that it's less than the majority. It's only 43% of the wealth managers who do this solely based on internal tools and methods. Yeah, but there is a bigger chunk, I think it's a 10-12%, who do this based on external tools or services, 100%, and lots of in-betweens. So this is one of the processes where wealth managers feel more comfortable to source expertise externally more often than with the other processes.
That's a pretty interesting picture. And if I look at the bars, I see that the red color dominates, especially on the portfolio construction side and also on the rebalancing side, which means that internal tools are favored. And Oliver, I would like to get your insights from the association. So do they build internal tools, or what is defined as an internal tool for your members?
Well, it's my interpretation or the association's interpretation for that. But I think many of our members and of the wealth managers in Switzerland basically have now bought a portfolio management system and work with that quite some time now. And I think they classify that already as an internal portfolio management tool. And that seems to be reflected by the high percentage that what kind of functionalities they use, i.e. portfolio construction, asset allocation, and rebalancing. That's classic modules that are included in the portfolio management systems that provide on the market. And it seems also to reflect the trend that we see that actually more and more wealth managers use portfolio management systems. Whereas my interpretation is when we talk about external tools, there are two, I would say, criteria we can basically refer to. One is the banking tools, i.e. the tools that are provided by the banks. They are obviously regarded as external tools, not internal tools, because some of them might even use several tools of several banks. So that's an external factor that I see. And when it comes to the whole product side of things, there I think it is not covered by the portfolio management system. This is rather a third-party vendor, i.e. exchanges or issuers. And they obviously are regarded as third-party who deliver data to the portfolio management system. And last but not least, you mentioned the whole risk management side that seems to be less reflected in the portfolio management system. That is the case because this is mainly managed, if you're not talking about pure portfolio management risk, i.e. risk of investments and investment compliance, this is actually handled also by the CRM, so client relationship management tools. So if it's in a client focus, that's a different system, and that's probably why it has not reached such high percentile on who is using that internally.
Very interesting interpretation. So the tools that are used on a daily basis are seen actually as internal tools, and add-ons provided by external providers are seen as external tools. So this is the status quo that we've seen. But I think, Manfred, we've also asked our community how they would like to change those processes going forward. Could you allude on the biggest changes, biggest shifts maybe?
Yes, absolutely. So we used the crystal ball, looked briefly into it, asked them, what are you going to do next year? 47% of the wealth managers said they would love to adapt at least one of the 5 processes that we suggested. So one of them, they say, yes, we will change it probably in the next year or in the next 1 to 3 years. But there are differences, though, if you look at each of the different processes individually. And the bigger picture is that most of the processes won't be changed. Like something like between 17% or 29 or 27%, they would be changed, and or they would use more external tools and services to better manage these processes. And a very few wealth managers said we will use less external tools. So overall picture, like 3/4 on average per process don't change, stay as is. But some of the processes, as I said, are more prone to change or being changed by using more external tools or services, and that is particularly the risk assessment and the portfolio monitoring process, where I think it's like the 29% of the wealth managers who say, yes, we like to use more external services, and also the product suitability process, where 27% of the wealth managers who we asked or who replied to our questions said we'd love to use more external tools or services to better get our head around these processes.
Very interesting. So these two categories being the main drivers, but overall seen almost half of the Swiss independent wealth managers would like to actually change one of those 5 processes that you've mentioned. Would be also interesting to know what the reason behind that is.
Yeah, I mean, we suggested some reasons so they could tick the box. We suggested 5 reasons and asked them, if you wanted to change one, which is the key driver of your appetite to change? And the key driver on average, so we built an average over all processes first, and then the key driver was very obvious. It was a desire to increase efficiency. They wanted more efficiency, which might mean more reliable processes, less admin, maybe quicker processes. So efficiency increases was the key driver if you averaged it out. If you followed by dealing with administrative, regulatory and compliance issues, that was kind of reason number 2. Reason number 3 was to improve the quality of processes. The other finding that we had is like growing clients was kind of one of the 2 least important ones. Well, I mean, you could comment on this. Maybe the question was framed in a way looking more at portfolio management processes. And cost also was not the key driver to drive costs down. That was mentioned as being a very important driver. If you look at 2 individual processes separately, there are 2 processes that stick out from the overall picture that I've just described. Yeah, this overall picture is applicable to portfolio construction, to risk assessment, and a bit also to rebalancing. The 2 processes that are different here again are product selection and product suitability. And with product selection, the key driver, the key motive is a desire to increase the quality of the process. With product suitability, it is obviously dealing better with regulatory and compliance issues.
Very interesting, but the main reason also to be more efficient with the red bar, with those 2 categories that stick out. Now, Oliver, would be pretty interesting to get your interpretation, because when I'm looking at the charts, I can see that many changes are linked to the actual operational side, but what surprises me personally is the client growth. So could you maybe share your interpretation of that chart?
Yeah, I think it's just momentum. The momentum is in a way that most of the asset managers are now licensed, and their main focus is now really running the business they are supposed to. So by actually using the systems, i.e. the portfolio management system now in a way that is most efficient. That's why efficiency obviously is a key driver in many polls we do. Efficiency in terms of process, as you said. Many who actually start to use systems realize it also makes their life easier, but you have to get accustomed to it. So I think the focus is really on the one side doing portfolio management and portfolio management system. which brings a lot of other value added, like direct connections with the depository banks, the way you trade, the way you rebalance your portfolio. So there's a lot of efficiency in there. I would say when you said the clients are not in the focus, I think the clients are in the focus in a sense still that, as I said, compliance with regulatory obligations is at the foremost important topic at the moment. That's, as I said, handled by the portfolio management system in terms of investment compliance, and if it's integrated in the CRM system, in the portfolio management system, or then outside. Having said that, portfolio management system is not the tool for client acquisition. It might be linked with the CRM, but that's pretty static in terms of monitoring what the client is, what he does, and monitoring his preferences. But it is not used as growing the client base, right? That would be a different system that helps you in the sales process. There are systems out there, but it's clearly not in the focus of the asset managers that we also saw in recent polls.
Yeah, I'm thankful for your comment, because I think we need to carefully interpret these data. I mean, the whole block of questions was about portfolio management processes, and obviously also the increase in efficiency will free some resources to cater better to client needs. And as you mentioned, a customer relationship management system is a different sort of story, right? And we didn't really go into this in too much detail, so I wouldn't overemphasize the client and growth thing here in this context. It is more efficiency keeps them busy, and CRM is a different thing, right?
It's different, yeah. And efficiency ultimately, as you said, is there to free up time for the clients, and free up time for the existing and for the sales process and acquisition process. So that's the idea. That's why the focus now is be efficient as much as you can in order to free up time for the clients again.
Great to hear that the client is at the center, even though we see the efficiency bars being pretty high. Now, if we jump on to the next topic, which is the ESG and the particular appetite for ESG, which changes, Manfred, can we see in this year's edition?
Yeah, I mean, basically, this year we've asked them two questions. The first one was like, what's your appetite in including sustainability criteria in your investment processes? And the second question that followed up on this, for those ones who answered yes, we include it, or we include it on client requests, then we asked them, what are your preferred ESG strategies, like you know them, the 7 or plus minus strategies, integration, exclusion, best in class, and so on. So these were the two questions. We asked them now in the third year. So this is why, for the first question that I mentioned, do you include sustainability criteria in investment processes? We thought it would be wise just to show like the 3-year development. And overall, it's pretty stable, so to say. It's a pretty clear picture here, and the story is simple. Approximately 1/3 of the wealth managers say, no, we don't do this. Yeah, we don't include ESG criteria. 20%, however, say, well, we do it by default. We always include ESG criteria no matter what. And the majority, well, I would call them being pragmatists. They say, it's like 48, 49%, almost half of them, they say, yeah, we are open to including ESG criteria if clients request it. And I think the picture is more or less stable if you compare it over time. What we saw this year was a slight 5% drop, though, of those who say we do it by default. So if you compare 2022 to 2023, we had in 2022 20% who said yes, always. In 2023, we had like 25% who says yes, always. And in 20, it dropped a little bit again. But overall, I would say it's stable. I mean, let me also give you, I mean, this is just a description, but let me give you also a piece of interpretation here. At first glance, it looks like only a fifth is integrating ESG criteria by default, it looks like not a lot. But honestly, it's the overall picture also if you look at other markets. So if you look, for example, at the retail fund market in Switzerland, which I know very well because we're doing studies every year, it's approximately the same picture. 20% or 25%, something in between, are those funds who are clearly positioned as being sustainable funds. So this is not kind of an outlier result here, but it's totally in line with the overall market. Even if sustainability is in the media a lot, it is still a niche market in brackets, but growing.
Very interesting interpretation, Manfred. So we're aligned here, no outliers. Would be also interesting to know the opinion of the association. Is that also aligned with what you see from your members?
Oh, very much. Very much so. I think it's demand-driven. ESG is really demand-driven. So if the end client asks the asset manager to do it, he does it. Not all of them, by the way, do it. Some of them, no, we don't do these mandates for a variety of reasons, predominantly in-house know-how in ESG and lack of systems to actually evaluate these ESG criteria. But we have the same picture. So it's really demand-driven by end client. It's most of the time non-systematic, actually. Let's not forget we still have this bias to the larger ones in this sample, so they probably do it. I think the large population even less. And what is the smaller ones? Sorry, yeah, the larger are doing more, and the smaller one are doing even less. And then, ESG, as I said, we realized that the interest is there, and I think it's something we have to pursue. But this year and last year, the client was looking for performance. I think, never forget, the asset manager is largely measured by performance on the portfolio. And I think that even triggered, unfortunately, a certain decrease in ESG portfolios.
Interesting additional insights. Now, you see that there is a demand if the client asks for it, but as we know, there are also different strategies or ways to implement these ESG needs from the clients. Manfred, could you maybe allude on the main preferences in this year's edition, and maybe if you also have some additional insights to the previous years, if we've seen any major changes?
So, what we see this year is the clear preference on average is for ESG integration. So you use sustainability criteria to better understand the financial fundamentals of a company. That is this year by far, I would say, the leading strategy on average. We also do a split here for those wealth managers who do include ESG strategies always, versus those who only do include ESG strategies on clients' request. But on average, that's the leading one, followed pretty much by the most simple to implement strategy, which is exclusion. Some call it negative screening. You just throw something out of your portfolio for subjective reasons maybe, or because it is a controversy around certain criteria of a company. These are the two leading ones. They are followed by a best-in-class selection or also a sustainable thematic strategy. The funny thing here is, if you compare that picture to last year, best-in-class and sustainable thematic were the leading ones, and that gave us a little bit of a puzzling impression, because we wouldn't have expected such a big shift. Basically, that shift is being explained by the different quality of the sample. We have, as I said at the beginning, we have much more larger wealth managers, and they have a stronger preference to integrate ESG overall, and then a stronger preference for ESG integration and for exclusion. That explains that shift if you compare these strategies to last year. What we also see is that impact investing, climate strategies, engagement and voting are not the most preferred. I mean, they are kind of being applied. They are not the most preferred ones. They are also the ones who require more resources, more knowledge, more processes. So that may explain why these are lagging a little bit behind.
So also interesting shifts to be seen there. Now, if I wrap the three main things up, right? Did I understand correctly that US stocks are in favor, but bonds also gain more ground? Mm-hmm. That secondly, the ESG appetite is given, but only if the client is asking mm-hmm. for that particular asset class, and also that there is a small bias towards more direct investments. So are these the key three findings?
Absolutely. These are the findings, and I would also add that kind of when you implement your processes, most of them are small and medium companies, they pretty much rely on their own good know-how.
Excellent. I would say with this, we can open the Q&A session, Manfred, mm-hmm. and I will just check the live questions that are coming in. I can see one, which is, are there any differences between the ESG preferences between smaller wealth managers, smaller sized and bigger sized?
Mm-hmm. Yes, absolutely. I mean, I think we also addressed a bit of that one, but I can go into more detail here. I mean, mm-hmm. what we saw is that those wealth managers who do include ESG criteria by default, there is a much bigger chunk with the larger wealth managers. So 23%, if I'm correct, of the larger ones do include sustainability criteria by default, but only 16% do it by default if they are smaller ones. So there's quite a difference. I mean, the other thing is, if you look at those who do it upon client requests, here again there's a big difference. 50% of the larger ones say, well, if clients request it, we do it, but only approximately 30+% of the smaller ones, which is, I mean, that one is one to think about. I mean, if clients want it and you and only 1/3 say, well, we do it, well, you could have a debate here. Yeah, I don't want to comment on that one, but
maybe let's have a debate. I mean, would you say, is that access to data, Oliver, if you hear the difference between bigger and smaller ones, or how would you interpret this?
It's access to data and it's cost, definitely. And it has also something to do with whether it's part of your vita and whether that's the way you manage. I mean, portfolio managers have certain way, a certain bias also how to manage. They have some core strengths. So some might just to be reluctant because also, as we said, efficiency is in focus. So you probably also structure your business model around a business strategy and about a type of client and the type of investments you do and very good at. And in a smaller enterprise, that could be easily to lead to the conclusion to say, sorry, and I think it's professional mm-hmm. to say, there's nothing to do that they don't like ESG. I think the story is we don't feel comfortable enough to provide you with that service at the level that you're supposed to get it. And I think that's how I interpret it. I think it's actually a very professional way to go around the theme if you're not equipped in doing actually ESG implementation in your portfolio management process.
Yeah, I absolutely agree with you. I mean, it has to do with your positioning overall, with your value proposition. It might fit in, it may not. The other thing, I mean, we didn't look into this, but it would be interesting. It also has to do whether or not you directly invest or whether or not you use products. Because the one thing is much more demanding for an implementation than the other one. So lots of things that flow probably into that decision. Yeah.
With the trend to direct investments, that's what I was saying. Probably that is currently the driver for not going too much into ESG. Mm-hmm. Once there are other forms of investing, then probably the switch will come.
Mm-hmm. We're unfortunately up on time to answer further questions, but for the audience, we will get back to you with the answers. We have them in the system, and someone will get back to you from either the Lucerne University of Applied Sciences, the Wealth Management Association, or us, Vanguard. In that instance, I would like to thank you, Manfred and Oliver, for your valuable expertise and insights. I would like to thank the audience for joining this webinar, and most importantly, I would like to thank all the participants that made this study happen. You can download it right now at your resource center, or you can simply get the study booklet with all the results by clicking on the email that you will get. And with that said, I would thank you here from Zurich on our behalf, and stay tuned for the next year's Investment Pulse survey. Have a great day. Thank you.
Thank you.
Thank you very much.